Hello and good day everyone. We are the Group 4 and we will be reporting about Enterprise Risk Management or ERM, Corporate Risk Management.
Good day, everyone. My name is Angela Joyce Gizeo, and I will be reporting about the definition of Enterprise Risk Management, or ERM. So, ERM is defined as a process affected by an entity's board of directors, management, and other personnel, applied in strategy setting and across the enterprise, designed to identify potential events that may affect the entity and manage risk to be within its risk appetite to provide reasonable assurance regarding the achievement of entity objects. So let's run through the definition one by one. ERM is a process, ongoing, and following through an entity. So because risks constantly emerge and evolve, it is important to understand that ERM is an ongoing process. Unfortunately, some view ERM as a project that has a beginning and an end. While the initial launch of an ERM process might require aspects of project management, the benefits of ERM are only realized when management thinks of ERM as a process that must be active and alive with ongoing updates and improvements. Next, ERM is affected by people at every level of an organization. Given the goal of ERM is to create a top-down enterprise view of risks to the entity, responsibility for setting the tone and leadership for ERM resides with the executive management and the board of directors. They are the ones who have the enterprise view of the organization, and they are viewed as being ultimately responsible for understanding, managing, and monitoring the most significant risks of affecting the enterprise. But since risk is everywhere, each of the level of organization can influence its impact. Next, ERM is applied in strategy setting. An effective ERM process should be an important strategic tool for leaders of the business. Insights about risks emerging from the ERM process should be an important input to the organization's strategic plan. When deploying a strategic lens as the point of focus to identify risks, the goal is to think about any kind of risk, whether it be strategic, operational, compliance, reporting, or whatever kind of risk that might impact the strategic success of the enterprise. As a result, when ERM is focused on identifying, assessing, managing, and monitoring risks to the viability of the enterprise, the ERM process is positioned to be an important strategic tool where risk management and strategy leadership are integrated. Next, ERM is applied across the enterprise at every level and unit and includes taking an entity-level portfolio view of risk. So as I have mentioned before, because risk is everywhere, each level of organization influences its impact. Communicating and coordinating between different business units is key for ERM to be successful, since the risk decision coming from top management may seem at odds with local assessments on the ground. Firms that utilize ERM will typically have a dedicated enterprise risk management team that oversees the workings of the firm. Next, ERM is designed to identify potential events affecting the entity and manage risk within its risk appetite. So, as management and the board become more knowledgeable about potential risks on the horizon, they can use that intelligence to design strategies to nimbly navigate risks that might emerge and derail their strategic success. Proactively thinking about risks should provide competitive advantage by reducing the likelihood that risk may emerge that might derail important strategic initiatives for the business, and that kind of proactive thinking about risk should also increase the odds that the entity is better prepared to minimize the impact of a risk event should it occur. ERM is able to provide reasonable assurance to an entity's management and board. So, reasonable assurance includes the understanding that there is a remote likelihood that material misstatements will not be prevented or detected on a timely basis. Although not absolute assurance, reasonable assurance is nevertheless a high level of assurance. The best approach for the organization may be evaluating the program through a series of audits, completing a high-level assessment of the program, and then organizing a series of audits over time to provide assurance coverage in a reasonable sized way. Finally, ERM is geared to the achievement of objectives in one or more separate but overlapping categories. Okay, more about ERM. So, ERM is about designing and implementing capabilities for managing risk that matter. The greater the gaps in the current state and the desired future state of the organization risk management capabilities, the greater the need for ERM infrastructure to facilitate the advancement of risk management capabilities over time. ERM is also about establishing the oversight, control, and discipline to drive continuous improvement of an entity's risk management capabilities in a changing operating environment. It deals with risk and opportunities affecting value creation or preservation. ERM is a comprehensive and integrated approach to addressing corporate risk. It enables management to effectively deal with uncertainty and associated risk and opportunity, enhancing the capacity to build value. So in ERM, a risk is defined as a possible event or circumstance that can have negative influences on the enterprise in question. Its impact can be on the very existence, the resource, human and capital, the products and services, or the customers of the enterprise, as well as external impacts on the society, markets, or the environment. So basically, risk is uncertainty, bad things happen, but also good things. This is why we also use risk and opportunity interchangeably. Where there is risk, there is opportunity, and when there is opportunity, there is risk. More about ERM will be discussed in the following slides.
Good day, this is Cristel Di Marie Brenzuela reporting the need for implementation of Enterprise Risk Management or ERM. In implementing enterprise risk management, the overriding objective is to provide reasonable assurance to an entity's management and board that the entity's business objectives are achieved. There are 6 fundamental reasons for implementing ERM. Each serves to help elevate management of risks to a strategic level. Number 1 is reducing unacceptable performance variability. Firstly, ERM assists management with evaluating the likelihood and impact of major events and in developing responses to either prevent those events from occurring or manage their impact on the entity if they do occur. Most companies focus on traditional risks that have been known for some time, and only a few companies have a systematic process for anticipating new and emerging risks. Therefore, many companies often learn of critical risks too late or by accident. But with the help of ERM, it broadens the traditional risk management focus on low probability and catastrophic risks to a more expansive view on reducing the risk of any negative impact on critical sources of enterprise value. The consistency of operating performance is improved by increasing the emphasis on reducing earnings volatility, avoiding earnings-related surprises, and managing key performance indicator shortfalls. Hence, ERM improves the management of increasing risk mitigation costs and the success rate of achieving business objectives. Number 2 is aligning and integrating varying views of risk management. Traditionally, entities have viewed and assessed risk under a silo method where many different managers would view and monitor their specific risks. However, these risks span across different business functions and should not be monitored in isolation. Now, as mentioned, management is able to assess risk on an enterprise-wide basis when using ERM. Under ERM, management assesses and monitors risk from a high-level or portfolio view, which allows management to first identify risks and then analyze the enterprise-wide effects of these risks. Third is building confidence of investment community and stakeholders. The importance of risk management is talked more about by the institutional investors, rating agencies, and regulators in their assessment of companies. Because of it, management may be requested to disclose and comment on the organization's capabilities for understanding and managing risk to enable stakeholders to make informal assessments as to whether returns are adequate in relation to the risks undertaken. So, when companies increase the transparency of their risks and risk management capabilities, and also improve the maturity of their capabilities around managing critical risks, management will be able to articulate more effectively how well they are handling existing and emerging industry issues. Additionally, ERM allows entities to manage risks to within their risk appetite. As a result, entities are able to provide maximum value to stakeholders with reasonable assurance that risks outside their risk appetite will be prevented. ERM will help prevent future business failures and scandals. Also, a company correctly utilizing ERM will satisfy the requirements set forth by the Sarbanes-Oxley Act regarding adequate financial statement internal controls. Fourth is enhancing corporate governance. ERM and corporate governance are inextricably linked. Each augments the other. ERM strengthens board oversight, forces an assessment of existing senior management level oversight structures, clarifies risk management roles and responsibilities, sets risk management authorities and boundaries, and effectively communicates risk responses in support of key business objectives. Fifth is successfully responding to a changing business environment. As the business environment continues to change and the pace of change accelerates, organizations must become better at identifying, prioritizing, and planning for risk. ERM assists management with evaluating the assumptions underlying the existing business model, the effectiveness of the strategies around executing that model, and the information available for decision making. With the ERM, management is able to identify alternative future scenarios, evaluate the likelihood and severity of those scenarios, identify priority risks, and improve the organization's capabilities around managing those risks. As the environment changes, new risks emerge and are escalated in a timely manner for action and possible disclosure. These activities impact resource allocation for the organization as a whole. Lastly is the aligning strategy and corporate culture. ERM helps management create risk awareness and an open, positive culture with respect to risk and risk management. In such an environment, individuals can raise issues without fear of retribution. With respect to matters of enterprise-wide importance, ERM often centralizes policy setting and creates focus, discipline, and control. It clarifies the distinction between risk-taking and risk-avoidance behaviors, improves tools for quantifying risk exposures, increases accountability for managing risks across the enterprise, and facilitates timely identification of changes in an entity's risk profile. ERM encourages balance in both the entrepreneurial activities and control activities of the organization, so that neither one is too disproportionately strong relative to the other. In comparison, traditional risk management approaches are focused on protecting the tangible assets reported on a company's balance sheet and the related contractual rights and obligations, while the emphasis of ERM is on enhancing business strategy. The scope of risk management is enterprise-wide, and the application of risk management is targeted to enhancing as well as protecting the unique combination of tangible and intangible assets comprising the organization's business model.
Hi everyone, I am Albion Melvin Pugoy, and I am going to discuss about risk culture and essence of ERM. Let us now talk about the ERM process, developing a more risk-aware culture. Establishing a risk culture has become a fundamental building block of good enterprise risk management practices. For us to understand more how this culture becomes essential in the development and application of ERM process, let us first define risk culture. According to the May 2013 article from McKinsey & Company, authored by Krivkovich and Levy, A risk culture is a way in which its management and personnel collectively perceive and respond to risk. From this definition, it tells us that there is cooperation between the management and personnel in responding to whatever risk the company encounters. Why is this so? This is because ERM must be done on a holistic approach wherein all employees, regardless of position or authority, must be involved in order to determine all the possible risks of the company, put controls in place to keep the risks at bay, and try to reduce the effects of any risk. Another definition of risk culture was provided by Farrell and Hoon, stating that risk culture is a system of values and behaviors present in an organization that shapes risk decisions of management and employees. This definition suggests that risk culture is a company-wide philosophy employed throughout the company, wherein risk and compliance rules are communicated to all the management and employees to effectively manage and address corporate risk. Bearing in mind these highlighted words, as you can see on your screen, we can infer that risk culture involves an element of common understanding across an organization as to its risk behavior, which helps the management and employees make educated, risk-related decisions. Management's actions, as well as consistent ongoing communication around ethics and risk management, are the first steps in instilling such a culture. There are three common characteristics of sound risk cultures described by Krivkovich and Levy based on what they have observed in their professional experience. First, organizations with successful risk cultures recognize the reality that risk exists, and not just recognize them, but also be willing to do something about those risks. Another characteristic of organizations with successful risk cultures is when they seek out information about risk from all parts and levels of the enterprise and promote discussion about risk. So this is what I've mentioned earlier. The ERM must be done on a holistic approach simply because these risks are associated with a company's business model and strategies. As much as these strategies are communicated throughout the organization, the risks that come along with it must also be identified and placed control upon in an enterprise-wide approach. Lastly, organizations with successful risk cultures design appropriate risk management policies and processes and also hold personnel accountable for adhering to those policies and processes. Let us now focus on the essence of enterprise risk management. By nature, ERM provides for control mechanisms that enable the identification of risks and which meet the predefined objectives. According to the article written by Lynn Fountain, ERM is meant to empower business managers to make smarter decisions that maximize value, reduce costs, and balance risk and returns. In other words, ERM ensures that the organization takes as much risk as it can bear in order for it to grow at the highest rate possible. Well, risk may be inevitable and it can always be present in our daily activities, but being able to put sound risk mitigation measures in place through a successful risk culture will make the impact of these risks bearable or will even be totally avoided in some cases. Let me provide an example based on a true and real experience in order for us to have a clear picture of the essence of ERM. A friend of mine was actually an employee of a hotel in Cebu, which was once considered the first four-star hotel in the city before a major fire accident broke out and ravaged the building. Before the unfortunate event happened, the whole staff were oriented regarding the company's disaster management plan as part of their ERM, allowing them to prepare for any disaster, may it be accidental or natural. They were oriented as to their document's order of priority, which ones to save and which ones to leave in case they were ordered to immediately leave the premises. They also provided trainings and guides to the building's emergency exits in order to avoid or at the very least minimize casualties in case a fire broke out. These were all part of the company's ERM in order to avoid the risks associated with their daily operations, founded on a sound risk culture wherein all employees were well informed as to how they would manage risks.
Good day, this is Kate Bridget F. Auge, and I will be reporting about COSO ERM framework. But first, what is COSO? COSO stands for Commission of Sponsoring Organizations of the Treadway Commission. COSO is a committee composed of representatives from 5 organizations, namely American Accounting Association, American Institute of Certified Public Accountants, Financial Executives International, Institute of Management Accountants, and Institute of Internal Auditors. It was established around the 1980s in order to sponsor research into the causes of fraudulent financial reporting. Presently, its mission is to provide thought leadership through the development of comprehensive framework and guidance on enterprise risk management, internal control, and fraud deterrence designed to improve organizational performance and governance and to reduce the extent of fraud in organizations. First, the ERM framework by the COSO provides a more disciplined and consistent standard against which to implement and assess a company's ERM program. It also offers a more holistic approach that enables the alignment of the organization's strategies and operational and compliance processes across the entire company. This manages the business risks and opportunities and helps towards achieving value maximization for the entire enterprise. Next, it is important to note that COSO's guidance is not necessarily mandatory. However, it has been influential because it provides frameworks against which risk management and internal control systems can be assessed and improved. In short, it is a widely accepted framework for organizations to use. Next, ERM is a process-based approach where the various components interact as part of an ongoing iterative process. These relationships are presented in a 3-dimensional cube. COSO intended the cube to illustrate the links between objectives that are shown on the top, which are what the company wants to achieve, and the 8 components shown on the front, which represents what is needed to achieve the objectives. The third dimension represents the organization's units, which portrays the model's ability to focus on parts of the organization as well as the whole. To summarize, the ERM framework presented in a 3-dimensional cube includes objectives, which are what the company wants to achieve, either strategic, operations, reporting, and/or compliance. Internal environment components, which represent what is needed to achieve the objectives. This is also called risk culture of an organization. Lastly is the entity level, which represents the various units of the company. Let us briefly go over each of the components shown in the cube. Let's start with the objectives. The goal behind internal control systems is to achieve an organization's overall business objectives, and these include the strategic, operations, reporting, and compliance objectives. Strategic refers to the overall, long-term goals of the company. Operations focuses on the effectiveness and efficiency of the business operations, and these includes ensuring controls are in place and are designed effectively. Reporting focuses on ensuring transparency, timeliness, and reliability of the organization's reporting systems and process, including both internal and external financial reporting and non-financial reporting. Lastly, compliance focuses on setting internal controls in alignment with adhering to industry standards and regulations. Next are the 8 components. First is the internal environment, which establishes the tone of the organization, risk appetite, and attitude towards risk management, as well as the ethical values that the company gives importance to. Second is objective setting. The board should set objectives that support the organization's strategic goals while taking into consideration its risk appetite. Third is event identification. The organization must identify both internal and external events that affect the achievement of its objectives. Organizations must pay attention both to occurrences that could disrupt operations as well as events that may also be beneficial to the company. Fourth is risk assessment. Here, the likelihood and impact of risks are assessed and used as a basis for determining how to manage them. This also puts emphasis on the importance of employing a combination of qualitative and quantitative risk assessment methodologies. Fifth is risk response. Management selects appropriate actions to align risks with the risk tolerance and risk appetite of the company. This stage can be seen in terms of the four main responses, which are to reduce, accept, transfer, or avoid. The risk responses chosen must be realistic, taking into account the costs of responding as well as the impact on risk. Sixth, control activities. These refers to the policies and procedures that should operate to ensure that risk responses are effective. Once designed, the controls in place need to operate properly. However, due to the fact that humans will be the one to implement these, failure to operate controls may occur because they may not be taken seriously, committing of mistakes, and collusion between staff. The COSO guidance therefore stresses the importance of segregation of duties to reduce the possibility of a single person being able to act fraudulently and to increase the possibility of errors being found. Seventh, information and communication. Information systems should ensure that data is identified, captured, and communicated in a format and timeframe that enables managers and staff to carry out their responsibilities, and that the information provided to the management is relevant and of appropriate quality. It also must cover all the objectives shown on the top of the cube, and there also needs to be communication with the staff. Last is monitoring. The management system should be monitored and modified if necessary. This is based on the principle that unmonitored controls tend to deteriorate over time. So, these components are relevant and related to the entire entity, meaning they operate at all the levels, which are subsidiary, business unit, division, and entity level.
Good day everyone, I am John Lemuel Godin and I'm here to discuss about risk retention and mitigation. First, risk retention. It is the acceptance of the loss or benefit arising out of a risk when it takes place. This means that the company tolerates or accepts the loss or injury that a risk may inflict on the organization when the risk occurs. The risk is identified and defined, but the company just lets it be, so the risk is not avoided not transferred. So when is this risk retention viable? First, this is viable for small risks where the cost of insuring against the risk would be greater over time than the total losses sustained, or if the severity of the financial loss is not high and where frequency of occurrence is high, it is better to retain the risk. For example, a company which provides medical benefits to its employees may decide not to provide insurance for minor sicknesses like coughs and colds. Although the occurrence of minor sicknesses among employees may be high, but this might not harm the organization severely. In addition to that, the cost of insurance for these minor illnesses might be greater than the possible financial losses it might cost the company. So the risk is so minor that it is ignored or phased out when they occur. This method is also useful when the probability of occurrence is very low and a reserve within the organization can take care of such losses arising out of risk retention. All risks that are not avoided or transferred are retained by default. This includes risks that are so large or catastrophic that they either cannot be insured against or the premiums would be infeasible. There are also risks that are retained because their impact might be very severe and damaging for the organization, but their possibility of occurring is not likely. For example, a war risk insurance might not be useful here in the Philippines because the country might not be involved in a war in the next few years or so. Maybe it will become viable once there are reasons to believe that the Philippines might be involved in a war in the next few years. But as far as I know, I haven't really encountered a company that is insured against a war here in the Philippines. So Imagine paying for a war insurance in a country that is generally peaceful, so the costs of those insurance would be unnecessary. And maybe for those countries frequented by wars, terrorist attacks, riots, and the like, maybe they are viable. Also, wars are very destructive and catastrophic that it may render the insurance premiums infeasible. Here are some guidelines that the organization should consider in making decisions regarding risk retention. 1. Determine the risk retention level using the proper estimation of risk using sales projections, cash flows, contracts, liquidated damages, and guarantees. So the company should estimate first the risk using sales projections, cash flows, and etc. so that the company can decide whether they are willing to retain that risk. And that decision is also dependent on the risk appetite of the organization. Second, there is no precise formula for estimation of risks to be retained, but statistical averages of losses over time give an indication to estimate such losses. An example of this is the historical data for bad debts. They can compute the average amount of bad debts over time and use that figure to determine how much they should allocate for the allowance of bad debts. Lastly, ascertain the capacity for funding a loss arising out of retained risk, and that becomes the measure for transferring the risk beyond that level. This means that the organization should determine the level of risk that they are capable of absorbing, and if the estimated loss arising from that risk is beyond their capacity, then it is better to transfer the risk. Risk transfer is a risk management strategy that involves the shifting of the risk from one party to another. An example would be the purchase of an insurance policy. So, simply stated, the capacity for funding losses should become the measure in which decisions on whether the risk should be retained or transferred are based. Next is risk reduction or mitigation. This includes all measures taken to reduce the effect of the hazard itself, as well as the vulnerable conditions leading to the hazard. The mitigation is carried out such that there should be an ultimate reduction in the loss due to a hazard. So simply stated, risk reduction involves all the decisions or actions taken to either reduce how bad the end result of a risk will be or the chances of it occurring in the first place. This strategy is appropriate when, upon our analysis of the risk falls beyond the company's acceptable levels. So an action has to be made, and risk reduction is one of the actions that the company can make. Risk mitigation also implies a certain extent of preparedness on the part of the risk bearer because he is aware of the risk. This helps identify the parameters that lead to the disaster and mitigate parameters ahead of the eventuality, thus reducing the risk. A very classic example would be preparing for a disaster because we cannot control the forces of nature or we cannot reduce the chances of a typhoon or an earthquake from occurring. It is better that we come prepared. So we prepare our emergency kits or even reinforce our houses and our buildings so that when the disaster hits, the impact is mitigated at some level. So there would be less casualties and less damage. Many companies are also employing these risk reduction strategies like conducting earthquake or fire drills, preparing an evacuation plan, and etc. Other examples are requiring factory or construction workers to wear the proper safety equipment on site, installing CCTV cameras and buying electronic cash registers to reduce the risk of theft, and even purchasing derivatives because they can be used to mitigate the risk of economic loss arising from changes in the value of the underlying asset. Risk reduction or mitigation strategies can be as complex as a process change or cultural change in the organization, or as simple as a decision to stop doing something.
So, before we move on to the next strategy, I will first introduce myself. I am Viana Falcon, and I'll be briefly discussing all about mitigation strategy. So, Mitigation strategy, by definition, is taking steps to reduce the risk or the severity of an impact or probability of the occurrence. This plan recognizes the fact that effective community involvement and public awareness can largely minimize the impact of disasters. Community-based mitigation strategy strengthens and stabilizes the efforts of the administration. As shown on the right side of your presentation, are the list focus of community-based mitigation strategy. So first, this strategy focuses on community capacity building, including the formation of community emergency response teams, or aka CERT. So what is CERT? CERT is a program which educates volunteers about disaster preparedness for hazards that may impact their areas and trains them in basic disaster response skills. Skills such as fire safety, night search and rescue, team organization, and disaster medical operations. Second focus. This strategy also focuses on micro-risk assessment and vulnerability analysis, including hazard mapping, applied research and technology transfer, so that to improve the quality of forecasts and also to disseminate the warnings quickly to the people. Third is that it highlights the need for a disaster management legislation and relief. Including this are rehabilitation policies that would define specific roles and responsibilities, as well as setting up permanent administrative structures and institutional mechanisms for disaster management. Herewith are the examples of mitigation strategies. Examples are hazard-specific control activities such as flood levees or bushfire mitigation strategies, designing improvements to those infrastructure or services, land use planning and design decisions that would avoid developments and community infrastructures in especially those areas prone to hazards. Community awareness campaigns that increases knowledge of how to prepare for disaster events. Another examples would be community education programs, again to build knowledge of appropriate actions to prepare and respond for disaster event. Capital work such as levee bank construction to reduce the impacts of flooding. Annual programs such as vegetation management around essential services and essential infrastructures such as power lines. So to conclude, the concept of betterment, often considered predominantly within post-disaster recovery and reconstruction, it should also form a key consideration pre-disaster through proactive mitigation strategy, which aim to enhance and harden infrastructure to a more disaster resilient standard.
Good day everyone, I'm Darvilo Diasnes and will proceed to training strategy. As we now know, ERM optimizes risk-taking of an organization, so naturally this includes a Disaster Management Action Plan or DMAP. Now the training of the key community and social functionaries of the organization is an essential element for its successful execution. For the DMAP to be fully operationalized, there needs to be a training strategy, manuals for warning and evacuation, which list the tasks to be undertaken by the responsible branch authority, and the roles of the Emergency Operations Center or EOC and the District Control Room or DCR. The district plans specify guidelines for the community as well as NGOs and local community-based organizations in the advent of any disaster.
Before moving on to the next subtopic, let me first introduce myself. I am Eliza Joel Buna and I will be briefly discussing about community-based preparedness strategy. Starting off, a short overview. As defined by Allen in her study entitled Community-Based Disaster Preparedness and Climate Adaptation Local Capacity Building in the Philippines, it is a specific form of local level capacity building and represents increasingly important elements of vulnerability reduction and disaster management strategies. Its strategies leverage the knowledge and capabilities of local community resources. Successful implementation of this requires an understanding of the communities involved. In an organization or firm, it encourages the management and staff to plan and work together to reduce injury, death, and property damage and other potential hazards following a disaster event. Community preparedness will improve the ability of individuals and groups to reduce the effects of the hazard impact and manage the resources until assistance is available. Furthermore, it results from a process in which a community examines its susceptibility to hazards. This refers to vulnerability analysis, identifies human material resources available to cope up with these threats, which refers to capability and assessment. And lastly, it defines the organizational structures by which a coordinated response is to be made. This refers to plan development. This also includes emergency responses which undertaken to ensure survival and prevent further deterioration of the situation. Examples include search and rescue, immediate repair and restoration of critical facilities and utilities, conduct of damage needs and capacity assessment, food and non-food relief assistance, medical assistance, evacuation center management, and networking. Preparedness involves measures taken in anticipation of a disaster to ensure that appropriate and effective actions are taken during emergency. This refers like setting up systems for early warning, coordinative and institutional arrangements, evacuation and emergency operations management, public awareness, disaster and evacuation drills, and stockpiling. Moving on, so what must an effective plan have? Here are 6 important key points to remember. First, clearly perceive vision of hazards and develop hazard profile of the community and its neighborhoods. First and foremost is to collect the baseline information about the community. 3 important aspects under these are: first, population characteristics, which refers to the total number of the families and is further classified into male, female, children, and disabled people. Second, socio-economic characteristics, which involves income groups and economic activities involved. And lastly, physical characteristics, which refers to the information about the land area. Such information will help us analyze the socio-economic conditions of the area and will enable us to figure out their level of vulnerability, which will lead us to the second key point: assessment of risk and its vulnerability. This includes risk analysis, hazard mapping, resource inventory, resource mapping, and safe routes. This involves collection of information about the types of disasters, their dates of occurrences, their frequency of occurrence, and their destruction cost. It must be remembered that the assessment of disaster threat situations is a continuous process. Therefore, it should be done before, during, and after disaster events and involves community members with consideration of class, gender, age, culture, location, etc. Third key point is the identification of individual and community resources. This refers to resource inventory wherein local resources available are identified within the community. These local resources available are those that which can be harnessed and enhanced for further for disaster preparedness and response. This includes a listing of trained manpower, livelihood activities, water, health, education, sanitation, electricity, communications, and of course, transport facilities. Fourth, there must be a clear, simple, and specific definition of duties and responsibilities of each member, earmark various escape routes, and locate shelter sites. This also includes information about a local community task force and emergency director. Members would be further responsible to practice the plan and update the plan from time to time. Proper delegation of tasks is a must. It must be also multi-sectoral and multidisciplinary. This means that it must consider roles and participation of all stakeholders in the community. Fifth key point is that it should be structured as a simple checklist. Why? This is because when emergency arises, it is easy to take action and would not cause any more difficulties in executing the plan. Last key point is the local body or the local community shall form resilient focal communities or target groups. This means to enhance the community's capacity to build resiliency against future disasters without expecting any support from external agencies. The goal here is to reduce vulnerabilities by strengthening capabilities which can withstand and recover from stresses and shocks from the natural, physical, and socio-economic political environment. So these are the 6 key points, and it must be remembered that people's participation is essential in all phases of disaster management and contributes to building their capacities and capabilities. Also, this is only possible with concerted efforts and conscious policy at the top level of administration.
Good day, everyone. I am Abigail B. Sumalpong, and today I'm going to talk about the Geographic Information System. So, according to the National Geographic site, a geographic information system is a computer system for capturing, storing, checking, and presenting data related to positions on Earth's surface. So, it connects data to a map, integrate location data with all types of descriptive information. Thus, the Geographic Information System provides a foundation for mapping and analyzing that is used in science and in almost all industry that uses information that includes the location, and different types of information can also be compared and contrasted using this system. The Geographic Information System helps users understand patterns, relationships, geographic contexts, and it also helps in improving communication and efficiency, as well as better management and decision making. So, to cut it short, the GIS technology applies geographic science with tools for understanding and collaboration, which helps people reach its common goal, which is to gain actionable intelligence from all types of data. So, how does this work? So, for here we have maps, data analysis, and applications. So, first we have maps, which are helpful for analysis and determining hazard zones and effects of disasters. So, maps are the geographic container for the data layers and analytics, which allows users to access further information about specific areas on a map. Hazard maps can be created for cities, districts, states, or even for the whole country. It aids in analyzing and determining hazard zones and for likely effects during disasters. Some examples of maps are the heat and cluster maps. These maps can be usually or successfully used in identifying response priorities during disasters, developing action plans, quickly assessing disaster locations, and carrying search and rescue operations effectively. Next is we have data. So the GIS integrates many different kinds of data layers using spatial locations and mostly has geographic component. It includes imagery, features, base maps linked to a spreadsheets and tables. The third one is analysis. So the GIS can be used to display spatial relationships and linear networks. And spatial analysis lets people evaluate sustainability and capability, estimates and predicts, and interpret and understand. So the analysis enables evaluation of sustainability and capability, understanding, and aids in decision making. So the fourth one is applications. So GIS are now accessible in the form of applications or apps which can be used and can be worked virtually through mobile phones, tablets, web browsers, and desktops. So the GIS facilitates record keeping and obtains status and works that are critical tasks for disaster management. So as you can see in the illustration, GIS is a tool which are used everywhere and in almost all industries, and it's a tool to see the whole or everything in one image for which can be used in social factors, biodiversity, engineering, land use, and environmental considerations. So GIS allows people to see the world in a way by mapping the position and quantity of things, mapping the density of people and objects, and mapping any changes that occur. And it also allows people to find out what is happening in a specific area or a nearby area. And lastly, the GIS facilitate record keeping and obtainment of status or ongoing works that are the most critical task for disaster management. So that's it about the Geographic Information System. Thank you.
Hello everyone, I'm Rosemary Carabana and I'm here to report about value at risk. So what is value at risk? So value at risk or VAR is one of the most popular methods in measuring financial risks. There are different types of VAR such as long-term VAR, marginal VAR, factor VAR, and shock VAR. So value at risk is defined as the threshold value such that the probability of a portfolio making a market loss for a specific time horizon exceeds its value. Moving on, the probability level is specified as 1 minus the probability of a VAR break. So what is a VAR break? This is defined as a loss which exceeds the VAR threshold. Normally, the parameters are 1% and 5% probabilities and 1 day and 2-week horizons. While VAR represents loss, a negative VAR would indicate that a portfolio has a high probability in making profits. There are two kinds of VAR, so one is applied primarily in risk management and the other in risk measurement. So for a manager who is managing financial risk, the VAR is essentially a system and not just a number because it runs periodically and is compared to the movement of computed prices in opening positions over the particular time horizon. So on the other hand, using value at risk as a measurement is usually reported with other risk measurements such as standard deviation, expected shortfall, partial derivatives of portfolio value, and etc. So the value at risk has an advantage of a structured methodology of critically analyzing a risk that is available as part of the management function. Daily publication of a number of time and with particular statistical data enables the organization to maintain a high objective standard. So in this case, a robust backup systems and assumptions regarding default would need to be established. So another advantage is that it differentiates risk into two regimes. One is on normal days and the other on extreme occurrences. So inside the value at risk limit, the application of the conventional statistical methods is reliable. So out VAR limit risk should be analyzed with stress testing on the basis of data available on the long term and in the broad market. So the application of value at risk is to segregate extreme occurrences in an extreme way. They can be studied over a long term in a qualitative manner on the basis of day-to-day movement on prices, both quantitatively and qualitatively, as VAR can be best utilized to define risk as a market loss on a fixed portfolio over a fixed time horizon in normal markets. It would not be useful in abnormal situations.
Hello everyone, I'm Mona Grace Gonzalez, and at this juncture, I am going to report about the introduction to capital adequacy norms in banking industry, the evolution of Basel regime. Bank capital executes the significant role of preventing the bank from failure and acts as a buffer against possible losses. Capital adequacy is the least amount of capital a bank must reserve to execute the business, take advantage of profitable growth opportunities, absorb losses, and sustain the customer's confidence on it. Several bank crises and bank defaults motivate the Basel Committee on Banking Supervision to provide a comprehensive guideline in managing bank capital. The capital adequacy regulation is an international standard to safeguard the banks through setting a risk-sensitive minimum capital requirement. The regulatory authority sets the regulatory capital, and the operating banks are required to maintain the adequate level of capital. Now, in this part of the report, I'm going to discuss the evolution of Basel regime. So first, what are Basel norms? Basel norms or Basel Accords are the international banking regulations issued by the Basel Committee on Banking Supervision. The Basel norms is an effort to coordinate banking regulations across the globe with the goal of strengthening the international banking system. It is the set of the agreement by the Basel Committee of Banking Supervision which focuses on the risks to banks and the financial system. Now, what is the Basel Committee on Banking Supervision? The Basel Committee on Banking Supervision, or the BCBS, is the primary global standard setter for the prudential regulation of banks and provides a forum for regular cooperation on banking supervisory matters for the central banks of different countries and has issued three sets of regulations known as Basel I, II, and III. It was established by the central bank governors of the Group of 10 countries in 1974. The committee expanded its membership in 2009 and then again in 2014. The BCBS now has 45 members from 28 jurisdictions consisting of central banks and authorities with responsibility of banking regulation. It provides a forum for regular cooperation on banking supervisory matters, and its objective is to enhance understanding of key supervisory issues and improve the quality of banking supervision worldwide. Its administrative office is located at the Bank of International Settlements, headquartered in Basel, Switzerland, hence the name Basel Norms. Since the inception, the committee has established a series of banking standards to promote monetary and financial stability. So, as previously mentioned, the Basel Committee has issued three sets of regulations. The first is Basel I, which was published in 1988, which set minimal capital requirements for banks. These became law in Group of 10 countries in 1992, with Japanese banks being permitted an extended transition period. The requirements have come to be known as the 1988 Basel Accord. It focused primarily on credit default risk, with minimum capital requirement fixed at 8% of risk-weighted assets. It is also worth noting that India adopted Basel I guidelines in 1999. Now, since this part of the report tackles more about banks, let us answer the question, what is a bank for the purpose of Basel Accord? To understand the scope of the 1988 Accord, we need to clarify what we mean by bank. This is because some jurisdictions distinguish between banks and securities firms, and the Basel Accord or the Basel I applied only to the former. Now, under the Glass-Steagall Act of the United States had quite some time back made a distinction between commercial banks and securities firms. Following World War II, Japan adopted a similar legal distinction. The United Kingdom also distinguished between banks and securities firms, although this was more a matter of custom than law. By comparison, Germany had a tradition of universal banking which made no distinction between banks and securities firms. Under German law, securities firms were banks and a single regulatory authority oversaw banks. France and Scandinavian countries had similar regimes. The USA revoked the Glass-Steagall Act in 1999. Next is the amendment of Basel I in 1996, where they recognized the need for capital requirements. With banks increasingly taking market risks, the Basel Committee decided to update the 1988 Accord to include bank capital requirements for market risk. This would have implications for non-bank securities firms. Any capital requirements the Basel Committee adopted for banks' market risks were to be incorporated into future updates of Europe's Capital Adequacy Directive and thereby apply to Britain's non-bank securities firms. If the same framework were extended to non-bank securities firms outside Europe, then market risk capital requirements for banks and securities firms could be harmonized globally. In 1991,
the Basel Committee entered discussions with the International Organization of Securities Commissions to jointly develop such a framework. The two organizations formed a technical committee and work commenced in January 1992. Now, what were the different purposes of capital requirements for banks and securities firms before? So, for banks, they were primarily exposed to credit risk. They often held illiquid portfolios of loans supported by deposits. Such loans could be liquidated rapidly only at fire sale prices, which refers to the prices of a security and other product that are well below the market value. So this placed banks at risk of runs, which occurs when a large number of customers of a bank or other financial institution to withdraw their deposits simultaneously over concerns of the bank's solvency. As more people withdraw their funds, the probability of default increases, prompting more people to withdraw their deposits. So, although deposit insurance and lender of last resort provisions implemented eliminated the risk of bank runs, they introduced a new problem. Depositors no longer had an incentive to consider a bank's financial viability before depositing funds. Without such marketplace discipline, regulators were forced to intervene, often at huge cost to the exchequer. One solution was to impose minimum capital requirements on banks. Because of the high cost of liquidating a bank, such requirements were generally based upon the value of a bank as a going concern. Now, for securities firms, their primary objective behind stipulation of capital requirements was to protect clients who might have funds or securities on deposit with a firm. Securities firms were primarily exposed to market risk. They held liquid portfolios of marketable securities supported by secured financing such as repos. A troubled firm's portfolio could be unwound quickly at market prices. For this reason, capital requirements were based upon the liquidation value of a firm. Furthermore, in April 1993, the Basel Committee released a package of proposed amendments to the 1988 Accord. This included a document proposing minimum capital requirements for banks' market risk. Banks would be required to identify a trading book and hold capital for market risk under trading book and organization-wide foreign exchange exposures. Capital charges for the trading book would be based upon a crude value at risk or VAR measure broadly consistent with a 10-day 95% VAR metric. Similar to a VAR measure used by the Europe's Capital Adequacy Directive, this partially recognized hedging effects but ignored diversification effects. Later, VAR measure was changed modestly from the 1993 proposal, still reflecting a 10-day 95% VAR metric. Market risk capital requirements were set equal to the greater of either the previous day's VAR or the average VAR over the previous 6 days multiplied by 3. The Basel Committee's new proposal was adopted in 1996 as an amendment to the 1988 Accord. It is known as the 1996 Amendment and went into effect in 1998. The Basel Committee on Banking Supervision, after an extensive consultation process, redrafted its recommendations for credit institutions' regulatory capital requirements issued in 1988. The revision was motivated by the wish to adequately reflect current developments in banking and to strengthen the stability of the international financial system. So now came Basel II, which is a refined and reformed version of Basel I Accord. The objectives of Basel II are to encourage better and more systematic risk management practices, especially in the area of credit risk, and to provide improved measures of capital adequacy for the benefit of supervisors and the marketplace more generally. Basel II replaced Basel I in April 2006. Seen on the screen is the Basel II structure, which shows that the Basel II framework operates under three pillars: the capital adequacy requirements, supervisory review, and market discipline. Under the new Basel II regulatory capital requirement, interest rate risk in the trading book continues to carry a minimum capital charge. What is new is that interest rate risk in the banking book needs to be assessed in the review of capital adequacy. To calculate the minimum capital regulatory capital requirements, banks must differentiate between interest rate risks in the trading book and interest rate risks in the banking book. Next is the Pillar 2, which is the supervisory review process. Pillar 2 was added owing to the necessity of efficient supervision and lack thereof in Basel 1 pertaining to the assessment of a bank's internal capital adequacy. Under Pillar 2, banks are obligated to assess the internal capital adequacy for covering all risks they can potentially face in the course of their operations. The supervisor is responsible for ascertaining whether the bank uses appropriate assessment approaches and covers all risks associated. Now, the first component of Pillar 2 is the Internal Capital Adequacy Assessment Process, or the ICAAP. A bank must conduct periodic internal capital adequacy assessments in accordance with their risk profile and determine a strategy for maintaining the necessary capital level. The second component of Pillar 2 is Supervisory Review and Evaluation Process, or the SREP. Supervisors are obligated to review and evaluate the internal capital adequacy assessments and strategies of banks, as well as their ability to monitor their compliance with the regulatory capital ratios. Now, the third pillar, or the Pillar 3, is the market discipline. Pillar 3 aims to ensure market discipline by making it mandatory to disclose relevant market information. This is done to make sure that the users of financial information receive the relevant information to make informed trading decisions and ensure market discipline. Next is the internal ratings-based approach. The internal ratings-based approach is suitable for banks engaged in more complex operations with more developed risk management systems. There are two IRB approaches for calculating capital requirements for credit risk based on internal ratings. We have the Foundation Internal Ratings-Based Approach, or the FIRB, and the Advanced Internal Ratings-Based Approach, or the AIRB. Now, in FIRB, banks use their own assessments of parameters such as the probability of default, while the assessment methods of other parameters, mainly risk components such as loss given default and exposure at default, are determined by the supervisor. Now, under the ARB approach, banks use their own assessments for all risk components and other parameters. For operational risk capital estimation, there are three approaches: the Basic Indicator Approach, or the BIA, the Standardized Approach, or the TSA, and the Advanced Measurement Approach, or the AMA. Under the BIA, the capital charge is derived as a fixed multiple, which is alpha equals to the 15% of 3 years average gross income of banks. Under the TSA, different business lines are assigned individual gross activity measures, and the regulators determine the appropriate fixed multiple beta to calculate the regulatory capital requirement. The exposure indicator is gross income of various business lines of the bank. The beta values range from 12 to 18%. Many banks of India have already adopted the BIA as well as the TSA. Now, under the Advanced Measurement Approach, or the AMA, banks have to use their internally defined risk parameters based on their historical internal loss data on frauds, business disruption and system failures, execution, delivery and process, transaction processing risk, employment practices, business practices, etc. Loss history represents the inherent operational risks and the state of the controls at the point in time. Finally, banks can use value at risk, or VAR, models to estimate figure for unexpected loss and operational risk capital subject to the regulatory review and approval. Some banks in India have applied for AMA. Involvement of board of directors and senior management is a must for adopting AMA in a bank. So, as per existing Basel II rules, banks need to maintain minimum regulatory capital at 9% at risk-weighted assets, which internationally is 8%. Out of this, not less than 50% should be Tier 1 capital. Capital risk-weighted assets ratio, the formula for this is eligible Tier 1 and Tier 2 capital over the risk-weighted assets. Now presented on the screen is the three-pillar architecture of Basel II. Pillar 1 is the capital adequacy requirements, which improves the policies of Basel I by taking into consideration operational risks in addition to credit risk associated with risk-weighted assets. It requires banks to maintain a minimum capital adequacy requirement of 8% of its risk-weighted assets. Basel II also provides banks with more informed approaches to calculate capital requirements based on credit risk, while taking into account each type of asset's risk profile and specific characteristics. The two main approaches of Basel II include the standardized approach and the internal ratings-based approach. So the standardized approach is suitable for banks with a similar volume of operations and a simpler control structure. It involves the use of credit ratings from external credit assessment institutions for the evaluation of the creditworthiness of a bank's debtor. So the banks in India currently follow the standardized approach and they report risk-weighted assets for various credit exposures depending upon their external rating positions and hence compute capital requirement for credit risk. The better the rating of the borrower, the lower the risk weights assigned by the regulator. For example, where a AAA corporate rated by CRISIL, which is a rating agency in India, will attract a risk weight of only 20%, while a relative higher risky BBB corporate loan exposure will have to be weighed 100% to estimate risk-weighted assets. Finally, all these risk weights need to be added and multiplied by 9% to estimate minimum capital requirement for taking credit risk. To get the capital required to be held against any given loan, we have the amount of loan times risk weight times 9%. So before we move forward to Basel III, let us first have the comparison between Basel I and Basel II. So Basel I, which was introduced in 1988 and amended in 1996, was based on methodology for capital adequacy. Capital adequacy was based on risk-weighted assets. Basel I is not risk-sensitive. It is prescriptive. All credit exposures carried a risk weight of 100%, except for some sovereign exposures and mortgages. Under Basel I, the total capital of a bank should represent at least 8% of the bank's credit risk. Banks can have lesser capital than others. The implications under Basel I were every bank had to maintain same 8% capital. Thus, banks with good quality assets had no incentives. As a result, credit quality had to be lowered to increase returns. Low-rated exposures were subsidized by high-rated exposures, and Basel I has no provision for economic pricing by banks. Now, Basel II was based on three pillars, namely the capital adequacy requirements, supervisory review, and market discipline. Same with Basel I, the capital adequacy was based on risk-weighted assets, while as opposed to Basel I, it is risk-sensitive. The credit exposures carry risk weights based on credit qualities, and its risk capital is similar to Basel I, but efficient banks can have lesser capital than others. The implications under Basel II were banks with good quality assets have incentives because they can manage with lower capital. Better quality assets requires lesser capital. Risk pricing can be done by banks based on credit perception, and Basel II has provision for economic pricing by banks. After Basel II, Basel III guidelines were released which set out the following: higher and better equity capital. With higher capitalization, banks can better withstand episodes of financial stress in the economy. And the better risk coverage, introduction of a leverage ratio, measures to promote the build-up of capital periods of stress, and the introduction of new liquidity standards, which will be discussed later. In 2010 or in the late 2009, Basel III guidelines were released, while the Reserve Bank of India has released its final guidelines on implementation of Basel III capital regulation in India on May 2, 2012. These guidelines would become effective from January 1, 2013 in a phased manner. The Basel III capital ratios will be fully implemented as on March 31, 2018. This entails higher global minimum capital standards for banks. Implementation of Basel III is essential for restoring confidence in the regulatory framework for banks and to ensure safe, and stable global banking system. Furthermore, the guidelines of Basel III were introduced in response to the financial crisis of 2008. A need was felt to further strengthen the system as banks in the developed countries or economies were undercapitalized, overleveraged, and had a greater reliance on short term funding. It was also felt that the quantity and quality of capital under Basel II were deemed insufficient to contain any further risk. A key element of new definition is the greater focus on common equity. Banks have two main silos of capital that are qualitatively different from one another. Now, let's tackle the difference between Tier 1 capital and Tier 2 capital. Tier 1 capital refers to a bank's core capital, equity, and the disclosed reserves that appear on the bank's financial statements. It provides a cushion that allows it to weather stress and maintain a continuity of operations. The Basel III Accord raised the minimum capital requirements for banks from 2% in Basel II to 4.5% of common equity as a percentage of the bank's risk weighted assets. However, as per Reserve Bank of India new Basel III capital regulation, common equity or core tier 1 should be at least 5.5%, which is 1% higher than the original Basel III rule. There's also an additional 2.5% buffer capital requirement that brings the total minimum requirement to 7%. Banks can use the buffer when faced with financial stress. No Tier 2 capital refers to a bank's supplementary capital, such as undisclosed reserves and unsecured subordinate debt instruments that must have an original maturity of at least 5 years. It is considered less reliable than Tier 1 capital because it is more difficult to accurately calculate and more difficult to liquidate. It is also worth notating that Basel III also wants to ensure that banks' leverage ratio should be at least greater than 3%. Basel III regulation expects that banks, for its survival in future, must understand the importance of people perception about a bank's liquidity condition both short-term and long-term, besides internal management of liquidity. It emphasized that banks' liquid assets should be sufficient enough to cover net cash outflow. So two liquidity standards or ratios were proposed in Basel III. We have the liquidity coverage ratio or the LCR and the net stable funding ratio or the NSFR. So the liquidity coverage ratio is the ratio of liquid assets to net cash outflow for short-term liquidity management. In other words, the liquidity coverage ratio requires banks to hold sufficient highly liquid assets that can withstand a 30-day stressed funding scenario as specified by the supervisors. This is to prevent situations like bank run. On the other hand, the net stable funding ratio is for long-term structural liquidity mismatches, which requires banks to maintain stable funding above the required amount of stable funding for a period of 1 year of extended stress. The NSFR was designed to address liquidity mismatches and has started becoming operational in 2018.
So that ends our report, and thank you for listening.